So that's where I really got the sense of two things. One, how wide and diverse the real estate universe is in terms of what you could invest in, what can come up, and how it's always changing. That things like data centers didn't even really exist 30 years ago.
Welcome back to the Massive Passive Cash Flow Podcast. I'm Gary Wilson, your host. I'm so glad to have you back listening to the show or watching if that's the case, because now you can watch the recording on Facebook, LinkedIn, YouTube, and pretty much all over the place. So we appreciate you being on board listening and or watching. We have a great guest today, Cameron Hastings. He's a natural New Englander, and we just were having a great conversation about the being back home and the climate, the atmosphere, the culture, the food, everything is great about New England. If you've never been, anybody who's listening, I highly encourage you to visit up there. Just amazing people, lots of history, beautiful scenery, just Berkshires. I mean, the beach is just amazing. So, in any case, yeah, I'm starting to drift here thinking about all these amazing places. But we're going to be talking about strip malls, okay? But it's a unique approach, unique subject. So, first off, Cameron, I just want to thank you for being here, man. I'm watching what you're doing, and you're at such a young age. What you've accomplished is pretty astonishing. So, thank you for joining us.
Of course, Gary. Thank you for having me. Really looking forward to our conversation.
You got it. So why don't we start at the beginning? I know you had gone to school in Rhode Island and studied architecture, and actually that was what my preference was going to be, but I didn't get accepted. It was Virginia Tech, and they
Mhm.
called me down and they said, "Why didn't you just apply to general studies? You would have got in a heartbeat." Where I went to school was off farms. There was no hardly anybody went to college. The school
Mhm.
counselor had no clue how to do that. And so I thought, okay, I'll go to Old Dominion, study computer science, and come back later and get my master's. And of course, that never happened once I got used to the ocean and riding waves and stuff like that. And plus, I was making good money. But tell me about your story. What took you from architecture to doing this? Is there a segue there, like a natural connection, like a tipping point? If you wouldn't mind sharing, that would be awesome.
Yeah, it's something that happened over a number of years as I learned more and
Mhm.
kind of figured out how the industry worked. But like you said, I went to architecture school at Rhode Island School of Design, and then right after graduation, moved to New York. Started working for the architecture firm Gensler, and was primarily focused on designing office buildings, high-rise office buildings in Manhattan, some in LA, and some in DC. So we were both doing ground-up construction, brand new buildings, in some cases significant redevelopment of buildings, so redoing the facades. In New York, you have all kinds of air rights considerations where you can buy air rights from your neighbor and you can punch holes in your building and then add more on top. So we were doing a lot of really creative things that way. And then some were much smaller interventions. We're just going to redo the lobby. We're just going to do the conference floor. So in that role, I got to experience a couple of important things that shaped me later on. One was the different scales. So everything from this is what the doorknob is like to this is what the superstructure and the facade of the building is like, and how those different systems work at different scales. I found really interesting. But the more important part and where it kind of guided me towards where I am now is meeting my clients, meeting the developers that I was working with, and realizing that I was actually more interested in what they were doing than what I was doing as a designer. That when I first
Mhm.
started as a designer, I saw the role as being having a lot more power, or a lot more control over the ultimate product. But as I got into the industry, I realized that that's not really how it works. The developer,
Mhm.
the owner, the person who actually owns this project and commissions it and comes up with the idea from the very beginning, is the one who has control over that project and is the one that benefits from it in the long term. So I was also thinking about the business model of do I want to have my career being one-off projects where I just get paid once for a project, or do I want to be able to do something where I build it once or I renovate it once and then get to own it
Mhm.
for possibly the rest of my life, depending on the asset.
Yeah.
So I really liked that shift
Mhm.
as well. But I didn't really know what I was doing. I first started while I was an architect. I started flipping houses, trying to learn about how to do that. But I was basically taking the bus from Manhattan into New Jersey at nights and weekends and buying these houses that were, in terrible shape. And I understood the physical aspects of them, the design aspects of them, but I didn't understand the financial aspects. So I made some
Yeah.
mistakes with those early projects and realized that I needed to go get some more experience
Mhm.
and spend some time with the best people I could find. So I went back to grad school, got a master's in real estate development, and that's where I really honed the financial skills and where it kind of came together. Um, and I think also where I started to see some of the value in things that I hadn't seen before, that
Mhm.
understanding the ins and outs of real estate finance means that you can have a better designed project as well, not just a more profitable project. So seeing the
Mhm.
ways that there was synergy between my old kind of life and the new approach also was valuable. So right after grad school, I went and started
Mhm.
working for a multifamily developer. That was the first kind of project. I was working as a consultant, but a longer term engagement. So I was with them for about a year, and helped them both develop projects, sell off parts of their portfolio, refinance some of their portfolio, and in that role, learned a lot about specific asset, being an expert in one asset in one market, how that can be an advantage, but also how that can be a risk and a disadvantage. That it's not always the right time to be a multifamily investor in Jersey City. Sometimes that's the worst property type you could be an investor in among the 20 plus real estate asset class or property types. So from there, the last role that I had before I started working for myself was at Newmark, where I was a managing
Okay.
director in their portfolio strategy group. And there I got to work with similar types of clients that I worked with when I was an architect, so REITs and institutional investors and big companies, but across a much wider variety of property types. So I got to work in industrial and retail, in office, in lodging, and some multifamily in some cases, but mostly commercial, owner-occupier type properties, and then some even more specialized property types like data centers or electric vehicle battery manufacturing plants and what all that entails. So that's where I really got the sense of two things. One, how wide and diverse the real estate universe is in terms of what you could invest in, what can come up, and how it's always changing. That things like data centers didn't even really exist 30 years ago, and now are one of the more important property types. So understanding how dynamic the ecosystem is, and then how to think about properties as portfolios rather than just as individual assets, both as an investor, but also for anyone any kind of entity or individual that has a portfolio, how to think about the synergies between those properties rather than just as discrete assets.
Yeah. Well, what's interesting here is as you're talking, I realize, and I've thought about this before because I still design houses for fun. Um, but architecture is probably the one or one of the few industries where it really is an art and a science.
Mhm.
It's a to me it's a creative process which you have to understand the mechanics, the science behind buildings and foundation structure and HVAC and all that. Just I love it. I mean, I love the
Mhm.
subject, and but now, so you've been able to transition into the world of investing through your work experience, and now the focus is it looks like it's on unanchored strip center, right? And I also believe I understand you um, have your focus on female owners, female investors, which is awesome, and I'm sure that they appreciate that. So take us, if you wouldn't mind, kind of unwrap that for us a little bit. Why unanchored strip centers? Because if you look at across the country, clearly there's hundreds of MSAs out there, and then you have these secondary and tertiary cities and towns that have strip malls are more, or sorry, strip centers are generally going to be more of uh, a neighborhood center than they will in the bigger cities, where it's more of a just we've got to find a convenient place to get coffee and a head of lettuce. The
Yep.
same place. But what drew you to that? And is there a particular uh, demographic you're looking for as far as being out in the suburbs versus in the city, that kind of thing? And then I know this
Mhm.
is a loaded question, but the third part is, was there something that really got you drawn towards working with, you know, female investors and helping them?
Mhm. Sure. So this all started Celine Brighthouse, which is the company that I work with or for as a partner.
Mhm,
Focus on unanchored strip centers. This started about sometime last spring, where
mhm,
a former client of mine who I looked at some real estate projects she'd had been evaluating, did underwriting for her to see the potential of those. She came to me and with this concept about unanchored strip centers. I had done some work
mhm,
on the tenant side when I was at Newmark, helping companies expand or choose markets or choose individual properties for their retail outlets. And so I understood the asset class in a way, but I wasn't really familiar with it. I didn't, and at first I didn't know if it was a good idea. So I said, okay, Laurie, like let me do my research. And when I went into it, what I realized is that these unanchored strip centers were at the very beginning of institutional adoption. So
mhm,
right now, still about 90 to 95% are owned by individuals and families where they maybe own one up to three of them, but generally no more than that. And
mhm,
in some cases, they have a business in the center and they own the rest of the center. But a lot of it is that this is their owning that center or owning a couple of them is their business. And it's producing enough cash flow that it can pay for their family, it can pay for their housing, but it doesn't necessarily pay for itself over the long term. It doesn't necessarily keep up with the capex that's needed. So I saw an opportunity
mhm,
there because of the fragmentation of the market. And then understanding that it wasn't always going to be fragmented. Seeing some of the other
mhm,
examples like self-storage or which started happening in the 90s in terms of the consolidation. In
mhm,
the early 90s, it was a similar place, maybe 5, 10% institutional. Now it's more like 40, 50%. Single family rentals are a similar thing is happening right now. It's still only, maybe about 5%, but it's projected to get up into that 30, 40% range. So when
right.
that starts to happen, there's an opportunity, and it happens over a long period of time, a couple of decades. And so
Mhm,
we see an opportunity with this property type for those reasons, as well as what we saw happen during 2020 and the last 5 years in the aftermath of that disruption in terms of many more people working from home, the downtown retail being less important than it used to be, the neighborhood retail where now some people are spending 7 days a week in their neighborhoods where they used to only be spending really
mhm,
two. Those places where you can either walk from your house, take a short bike ride, drive a few minutes to, like you said, go get a coffee or go to the laundromat and do your laundry or go to the small grocery
mhm,
store and get whatever it is you're going to get for dinner, have just become more important. So the convenience aspect
mhm.
of that and the kind of realignment of where people are living and working has made a difference there. So to your question
Nice.
about urban versus suburban, we do look more at suburban kind of inner ring of big cities. We're particularly
Mhm.
focused in Southern California and Dallas. And there's
Okay.
really three reasons for that, I'll say. One
Mhm,
is that Lori, the founding principal, is based in Southern California,
mhm,
and our other partner is based in Dallas. So they're kind of our home markets. They've both been there for most of their lives, decades. So they
mhm,
have they have deep experience in those markets, which part of what I learned in my first role as a multifamily developer is the importance of that, really understanding your
mhm,
market. Especially if you're a small investor and you're trying to have little properties all over the country, it's really difficult to manage, and you can't understand every market the way that you need to make intelligent decisions about investments. So that was kind of the first step. The second step is we realized that those two markets were also the largest and the most liquid for these particular properties. Particularly Southern California was the most liquid last year, but both of them are very large.
mhm,
Uh, Within those two markets, there's about 15% of the entire nation's supply of strip centers, of shopping centers in general, actually.
mhm,
So we knew that we would have a lot of options on the acquisition, but they were also markets that larger scale institutional investors that we're looking to sell to in the end are already comfortable with, already operating in, already have teams in. So that makes that exit, especially thinking about exiting as a portfolio rather than exiting as individual assets, makes sense to go after those two markets.
Did you know that you can participate in class every Monday? We call it Monday Night Live, 7 p.m. Eastern, with me and dozens of other investor agents from around the country, in fact, the world, every Monday, totally free. No selling, no recruiting, just straight up education on anything and everything in real estate. And we have a lot of good guests coming on once or twice a month, bringing in expertise on subjects like how to buy a house with crypto. Okay. How about them apples? What about AI? How's AI affecting our business? How about the metaverse, blockchain processing? We're already using it in title work. So come on to Monday Night Live. Be ready to take notes and ask questions because it's live and engaging, and you get to participate by asking questions and meeting others. So we'll see you there. Go to realestateWithGaryWilson.com, click on the resource tab, drop down, and you'll see Monday Night Live. And in there, you can see one of the most recent classes. But more importantly, you can register for class as many as you want going up to like the end of the year, I believe. So in any case, do that. We'll see you on Monday Night Live. Look forward to meeting you in person. Take care. Wait, I appreciate that. This is, I hope everybody listening is, unless you're driving, taking notes because you're getting a lot of gold nuggets here. And so I think probably a good follow-up question would then be, um, timing. It's hard to time things. I mean, real estate, it's easier to time things in real estate than other uh, types of investments because real estate is typically a slower moving commodity. But when it comes to the strip centers, it wasn't too long ago when they were not a favored asset class. I mean, we had even a Great Recession, and I mean, you could just drive down the road in any town anywhere and see businesses were just basically
Right.
closing their doors. And this is now, of course, 15 years ago. But now they're favored, among a lot of investors. And I
Mhm.
mean, is there can you unwrap that a little bit? The transition,
Mhm.
the evolution of that going from where they are is maybe being undesired to where they are now to being quite frankly pretty desired.
Sure. So I would start the story for these strip centers in the early 2000s, say 2004 to 2006. The country really built a lot of these. So there was a lot of
Mhm.
retail development. We already were, but we became, as Americans, even more so the highest retail square footage per capita of any country. And it got overbuilt. So we were in this period where real estate was booming, the economy was booming, all of these businesses were coming up and taking more and more retail space was being built. And then we hit the global financial crisis, which hurt those businesses. But we also got to a point with the retail properties where e-commerce was starting to be a bigger threat. So there is this concept of the retail apocalypse. So both of those things, oversupply, businesses failing because of the global financial crisis, and this new surging e-commerce, which at the time nobody really knew how long it was going to take to get to 100% e-commerce. There's no stores anymore. That was kind of in the 2000 teens. That was a fear that you wouldn't have any stores, that Amazon would be everything. Still today, it's about 20% of all sales happen online, 80% happen in person. It is inching up, and we saw a spike in 2020, and then it headed back down. But it seems to be settling around that range, especially as businesses see ways that they can have an omni-channel approach where they're selling online, they're selling in store, and there are ways to make those work together so that both channels perform better. In the research, we actually see that when a brand has a physical store in a market, in a city, in a metro, their online sales in that metro end up spiking. So even though people aren't going to that store, just having that presence there, maybe they're driving by it and then they go home and order something online, that also
Right.
helps the business. So some of the things that there were real structural problems that happened
Mhm.
in terms of oversupply. There were some misplaced fears around retail in general.
Mhm.
And I also think that where these unanchored centers differ a lot from the big box stores or malls is that they're more necessity focused than discretionary focused. So where malls or some big box stores are struggling because of e-commerce shifts or others, um, These centers are doing quite well. They've been very resilient over the last few years. Occupancy's at a 20-year high, around 95%. They're basically full across the country. That 5% is essentially frictional vacancy rather than something that's really telling the market they would be full if you could do that. So part of the last 10 years or so is that because of those factors that happened in the previous 10 years, there's been almost no supply added. Supply is growing at about 0.25% a year, which is what's
Okay.
influencing that occupancy number. So it's kind of a reversal of what
Hmm.
we had before the global financial crisis, where still there's almost no construction. And we've gotten to a point where it's I don't think we will see much new construction for some time, both because of interest rates, but mostly just because of how expensive it's become to build these things. It costs, based on CBRE data, as a national average, so our markets will be even more than this. It costs somewhere between $400 and $500 a square foot to build a new center. But for us, we
Wow.
can we
That's
can
yeah.
buy existing ones for 200 to 300 for a pretty good quality
Okay.
center. Not a brand new one, but a good quality
Hmm.
center that's full. So that also limits the competition going forward. Rents are going to have to grow quite a lot for it to make sense to start building again.
Yeah. Well, you know what? I think what you just described there is it kind of leads me to the next question, even partially answered it. So, um, I guess what I'm getting at is, when you have something like this that it starts to evolve, which is what we were just talking about. Clearly, the big we call them the whales want to start getting involved. So, what are the factors driving the consolidation, of these properties into the larger institutional portfolios? And then is there a kind of a boomerang effect? Is it hurting, smaller investors, or does it actually help because maybe smaller investors can grab these properties, um, do the work to remodel them, do a
Mhm.
value add, and then let the big, what we call the whales or institutional portfolios gobble them up. I don't know if I'm
Mhm.
making sense, but I'm trying to. I can see that this is without me knowing for a fact, because I have not invested in this asset class, but I imagine the bigger portfolios are really starting to have taken notice. And
Mhm.
what are some of those factors? And then how does that affect um, you know other investors? The market dynamics.
Mhm. Yeah, so you're absolutely right that this is institutional investors starting to take notice, and smaller investors actually have an important role to play in this, similar to what they've played in other property types where you tend to have small individual assets. In multifamily or an office building in New York, you can have one property that's worth $1 billion. You can't do that here. Once you get above, say, 15 million, it really changes into a different kind of property. It becomes a power center, or it becomes maybe a very small mall. And the economic drivers of the fundamentals really change. So you can't build your portfolio by just buying bigger and bigger assets. You need to buy more and more assets. But for an institutional investor, especially one that is broadly diversified, someone like JP Morgan, for example, or Nuveen, both of whom are starting to look into these properties, they're not really set up to do the value add and consolidation part. They're set up to buy existing stabilized portfolios and continue operating those. So the role that smaller investors can play in this ecosystem is doing that early work, doing the value add, doing the consolidation, putting consistent standards in place across the portfolio, having them managed as essentially one economic entity, so that when the big players come into that market looking, instead of buying one $5 million property at a time, they can buy a $50 million portfolio that a smaller entrepreneur has assembled. And that's part of our strategy and what we see happening in the market. There is one publicly traded REIT that is now focused on these. It's called Curbline.
Okay.
It was a spin-off of Site Centers. And what they kind of did was they had a more diversified shopping center portfolio, and they decided to just spin off the unanchored properties into a new company, which is actually
Mhm.
now bigger than the original company, and kind of has more promise. So we're seeing some of that shift. I think the last thing I'll
Okay.
say about the on the institutional side is I think that there's also becoming more risk appetite in terms of credit tenant credit quality
Hmm.
that maybe 10, 15 years ago, if you didn't have a credit tenant, you didn't want the
Hmm.
property. But now seeing how resilient some of these smaller businesses are, especially if you have a larger center with smaller spaces, if you have you could have a 40,000 square foot center with 25 spaces, maybe they're all pretty small. So each individual tenant becomes less important, becomes a little bit more like how multifamily or self-storage works, in contrast to either a single tenant retail or maybe one that just has many fewer tenants. So you have some of those opportunities. And then when you have a space that's 1,000 square feet, 2,000 square feet, that's maybe $1,000 a month, there are a lot of businesses that can take that space. Whereas if you have a former Target or a former Home Depot, there aren't very many businesses that can take that space. You really need another big national tenant. So there's a little bit more flexibility with the unanchored spaces because of the size of the units as well, which
Yeah.
while you don't have the tenant credit quality, it's safety in a different way. That I think
Right.
some of the larger institutional investors are starting to recognize that credit quality isn't everything in retail.
Okay. Wow. All right. Well, I'll tell you what, you mentioned the word risk, and that was actually kind of my next question. Um, so how do you manage risk, or how do you approach risk management? And this is probably more of a broad-based question because I'm sure it doesn't just apply to um, the consolidation of the strip centers.
Mhm.
Um, but really, let's just talk about the strip centers and what's your approach here? You just kind of touched on the tenant quality and things like that. But what are some of the other factors?
Mhm. So there's a couple of things that we're doing in our portfolio to mitigate risk. One is just that
Mhm.
two city focus, two metro focus, so that we have some diversification, but not maybe over diversification where we can't manage it. So we have these two markets that really have little to do with each other economically. It's not like it's Dallas
Mhm.
and Austin, which maybe have a lot to do with each other. Southern California and Dallas have pretty low correlation in terms of what happens there economically, and they can even be one can be the beneficiary when another one loses. Either companies moving, Californian companies moving to Texas, or now we're seeing some Texas companies moving to California. So it's kind of that's the first layer. The second part is looking at the property level for additional diversification within the tenants. So understanding what industries they're in and making sure that we don't have all tenants or most tenants that are going to be affected by one kind of thing that happens in the economy. And that's really by focusing on businesses that have more durable demands through economic cycles, and that are really necessities. So some of these properties have doctor's offices or dentist offices or things that you both can't do online and you need, or things that are more kind of everyday non-discretionary, like a laundromat or dry cleaners or something like that, hair salon or barbershop, things that there's less risk that they will be disrupted, that these are kind of old business models. We're typically not interested if a tenant comes with, I've got this brand new concept that's going to be big and we're going to open 1,000 stores, but we don't have any right now. That kind of tenant we're less interested in. Much more so looking for centers where there's been a tenant in place for, in some cases, decades. We have one property we're looking
Mhm.
at right now where there's been a pizza restaurant there since 1995. So,
Mhm.
quite a while. And a simple business. So, we want to make sure that our tenants have simple, durable, resistant businesses. And that's
Yeah.
part of the safety as well. And then the last thing I'll say about the risk mitigation is looking at
Mhm.
kind of light value add versus heavy construction. So because of
Okay.
how variable construction costs have become, I think the
Mhm.
tariffs that have gone in place recently will also affect that in terms of getting raw materials, steel
Mhm.
or aluminum. And some of those things are just you don't know when kind of thing is going to happen. So when we look for properties, we look for ones that need more operational help rather than need significant construction. So ones that are well maintained, but maybe they need a different paint color. They need more the stucco needs to be redone, which is makes a big visual difference, but isn't very complicated to do. Or the hedges need to be trimmed because they've been let to go wild, or the plants need to be watered better, or something like that. We need a couple more lights on the sign. So not complex things, not complicated things, not particularly expensive things to do, but things that have a big visual impact and a big perceptual impact. So when you go to this center, it feels better, even though it hasn't changed all that much.
Yeah, yeah. Um, as far as geography, Southern California, Texas, are there other markets that in your analysis could make sense, but it's just easier for focus on those two markets because I mean, obviously, in any business, you know, the smaller your work area, the easier it is to manage, and you're
Right.
probably going to have less risk and better results. But is that part of your why you're choosing just the two, or are there for people listening? I guess the question is, what about Wichita, Kansas, Macon, Georgia, places like that? Or did any of those ever pop up on the radar screen?
There are definitely opportunities for those, and I mean, I get probably 30 listings a day for strip centers around the country from various brokers. So yeah, there are plenty of opportunities in other markets. The size of and liquidity in those two markets that we've chosen is important to us. When you go to a smaller market, you probably won't be able to buy unless you're spending a long time in that market. You probably won't be able to buy several properties in that market right away. You may be able to buy one, and then a couple of years later, another one that you like will come up. Whereas if you're in a bigger market, a more liquid market, you can have a much more concentrated portfolio. Where in some cases we're looking at multiple properties that are a couple of blocks away from each other, that are essentially competing properties to each other. And that I think in managing has an advantage. But for investors that maybe are looking for these types of properties for themselves, they're everywhere. There's about 115,000 shopping centers across the country. Around 1,000 of those are
Okay.
malls, so the rest of them are smaller scale. And in markets that are more car dependent, so less so the Northeast, Boston, New York, DC, these aren't as common. But Florida, throughout the South, definitely Texas, definitely all over California. They're everywhere, and there's a big opportunity to make improvements to those properties.
Yeah. Well, I guess I know we're going to run out of time here probably pretty quickly, but I do have another uh, question on the portfolio. There's private and public real estate markets, and
Mhm.
how can the investors leverage both for to achieve a diversification?
Mhm. So the it took me a while in my career to really learn the value of the public markets. I kind of knew about them, but I didn't see why I should give my money to someone else when I could buy my own property and do it myself.
Hmm.
And what I've learned over the course of my career, and something that we apply in my business too, is that specialization and focus. That because real estate is so diverse that there are at least 20 property types, maybe 30, depending on how you segment each one. You can't be an expert in each property type, let alone each market. So when you're thinking about 50 big MSAs, 30 different property types, there's just no way that you're going to excel at having a diversified real estate portfolio only in the private markets. Even if it is investing through other sponsors, it's difficult to find them across all of those property types. And then there are some property types like data centers, an example, casinos are an example, where each individual asset is just so large that your minimum ticket as an investor is maybe 10 million or 100 million in some cases. Like a casino in Las Vegas, you can have one building that's $3 billion. So in for property types like that, where it's already been consolidated, institutions own most of these properties already. They're very large, they're very complex. There's high barriers to entry, both in terms of cost, in terms of complexity, and regulatory barriers, like again, a casino needing a license that is very limited supply. Uh, those are the areas where I usually suggest investing in the public markets. That it's
Okay.
really hard to have an advantage there. But then for the property types like unanchored strip centers or single family rentals or some of these that are starting to be institutionalized, have attractive fundamentals, but the market is still very fragmented. No one really controls the whole market yet. There are some emerging big players, but there's no dominant player. Those are areas where I think that as a smaller scale investor, whether you're an individual or you have a small private equity firm, those are areas where you can really excel. And then if you put those two together, you can capture the whole universe of what's available within real estate and digital infrastructure, which I think is really compelling.
Well, I'll tell you what, we really covered a lot here, Karen, and I so much appreciate your taking the time to do this and being so prepared. When it comes to Celine Brighthouse, is this something that people can find information on, or how if people want to speak to you about this or
Mhm.
gather more information, what's the best thing that they can do? You know?
So the best thing would be either going to our website, which is celinebrighthouse.com, or emailing me at cameron@celinebrighthouse.com.
Okay, good, nice and easy. So, guys, if you remember the website, or write it down, celinebrighthouse.com, and then Cameron at celinebrighthouse.com. You can't go wrong. So, for everybody listening, I hope you enjoyed this as much as I did. This should open up another asset class for you. Clearly, the trend is there, and it likely will continue for a while. And just like Cameron mentioned the storage back in the '90s, and I knew that and decided not to take advantage of it because I was, well into multifamily, and I didn't want to, you know, bite off more than I could chew. But in hindsight, that is definitely something I should have taken advantage of. This has been going on for a bit, but it's not completely mature yet, so you got plenty of time. I highly encourage you to look into it. Do your own due diligence, of course, just like anything. And by the way, if you could remember to please leave a review for the podcast, we would greatly appreciate it. Both Cameron and I, we your reviews mean everything to us because we don't actually exchange money. There's nobody's making money getting paid. It's all about relationship building, providing value to you, the listener. And so your reviews is your way of voting for, yeah, you like this one. So in any case, we appreciate that. We appreciate you, Cameron. For everybody, please take care of yourselves. God bless you and your loved ones. And we will see you on the next Massive Passive Cash Flow podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.